Something unprecedented is happening in the gold market right now, and most people have no idea they're standing at the edge of an economic cliff. While mainstream media talks about stock market gains and economic recovery, there's a silent alarm ringing in the halls of central banks worldwide. They're buying gold at a pace we've never seen before. Not just buying it, hoarding it. And if you understand what that means, you'll realize why the next 12 months could redefine wealth preservation for an entire generation. Let me paint you a picture of what's actually happening behind the scenes. In the first half of this year alone, central banks added over 400 tons of gold to their reserves. That's 24% above the 5-year average. These aren't amateur investors making emotional decisions. These are the most sophisticated financial institutions on the planet, run by economists who have access to data you and I will never see. And they're moving their nation's wealth into gold like their future depends on it. Because it does. Think about that for a moment. Central banks don't make impulsive moves. Every decision is calculated, analyzed, and stress-tested. When they pivot this dramatically toward gold, they're not reacting to last week's news. They're positioning for something they see coming down the pipeline. Something big enough to justify abandoning decades of dollar-centric reserve management. The gold price has been on an absolute tear. We breached $3,000 per ounce earlier this year, setting a new all-time high. But here's what most analysts are missing. That wasn't the top. That was the floor resetting. Industry experts are now saying that $3,000 represents the new $2,000. Let that sink in. The baseline has shifted. We're not talking about gold returning to previous highs. We're talking about a fundamental repricing of the entire precious metals market. And it's not slowing down. By late summer, gold had climbed even higher, and as we approach year-end, we're trading near $4,000 per troy ounce. That's not a typo. $4,000. Gold has essentially doubled in value in under 2 years. When was the last time you saw an asset class do that while maintaining this level of institutional support? This isn't retail FOMO driving prices. This is smart money, the smartest money, making a calculated bet on gold's role in the future financial system. Now, let's talk about why this matters to you. Because this isn't just about gold bugs celebrating higher prices. This is about the structural integrity of the global financial system. When central banks diversify away from the US dollar at this pace, they're sending a message. They're saying, we don't trust the current system to preserve our wealth. And if the institutions that literally print money don't trust fiat currency, why should you? The US debt situation has reached a critical point. We're looking at a debt-to-GDP ratio that climbed from just under 100% to over 102% in a single year. David Kelly from JP Morgan put it bluntly, America is going broke slowly. That's not a conspiracy theorist on YouTube. That's one of the most respected voices in institutional finance. When someone at that level uses language like that, you need to pay attention. Here's what's happening beneath the surface. The Treasury is issuing debt at unprecedented levels just to keep the lights on. Interest payments on that debt are consuming an ever larger portion of the federal budget. We're approaching a point where we're borrowing money just to pay the interest on money we've already borrowed. That's not a sustainable model. That's a debt spiral. And history shows us exactly how those end. But it gets more interesting. Throughout this year, we've seen warning signs flashing across multiple economic indicators. The jobs market has shown strain, consumer sentiment has been volatile, inflation remains persistent despite aggressive rate policies, yet somehow we've managed to avoid an official recession. How? By redefining metrics, adjusting expectations, and essentially moving the goalposts. But you can't outrun mathematics forever. Top economists have been sounding alarms. Moody's Analytics chief economist described the U.S. economy as being on the precipice of recession. That was months ago, and the underlying conditions haven't improved. They've intensified. High interest rates are squeezing businesses and consumers. Automation is threatening middle-class jobs at an accelerating pace. The economic foundation that supported prosperity for decades is cracking. And this is where gold becomes more than just a commodity. It becomes a lifeboat. Because when the system resets, and it will reset, The assets that maintain value through that transition will determine who preserves their wealth and who loses everything. Let me tell you a story that illustrates this perfectly. In 1971, President Nixon closed the gold window, ending the direct convertibility of dollars to gold. At that moment, gold was $35 per ounce. Most people didn't understand the implications. They trusted the system. They believed the dollar would remain stable without gold backing. Within 9 years, gold hit $850 per ounce. The people who recognized what was happening and positioned themselves accordingly didn't just preserve their wealth. They multiplied it 24 times over. We're at a similar inflection point right now. The difference is, this time the stakes are higher and the timeline is compressed. The global financial system is more interconnected, more leveraged, and more fragile than it was in the 70s. When the reset comes, it won't unfold over a decade. It'll happen in months, maybe weeks. Look at what's happening with BRICS nations. Brazil, Russia, India, China, and South Africa, along with new members, are actively working to create alternative payment systems that bypass the dollar. They're settling trade in their own currencies. They're building infrastructure for a multipolar financial world. And at the center of their strategy? Gold. They're accumulating physical gold because they understand it's the only asset that every nation recognizes as having intrinsic value. China has been particularly aggressive. While they don't always report their full reserves, analysts estimate they've been adding hundreds of tons to their holdings. Russia has been doing the same, especially after Western sanctions demonstrated how weaponized the dollar system has become. These aren't small players. These are major economies representing billions of people, and they're systematically reducing their dollar exposure while increasing their gold positions. The implications are staggering. For decades, the U.S. dollar's reserve currency status has allowed America to run massive deficits without immediate consequences. Other countries needed dollars for international trade, so they bought U.S. Treasury bonds, essentially funding American spending. But if that demand decreases, if countries start settling trade in yuan, rubles, or gold-backed instruments, the entire dynamic collapses. Treasury yields would spike, the dollar would weaken, inflation would accelerate, and Americans would feel it in every aspect of their daily lives. This is why gold isn't just going up because of inflation fears or geopolitical tensions. Those are symptoms. The real driver is a fundamental loss of confidence in the fiat currency system itself. And once that confidence erodes past a certain point, it doesn't come back. History is littered with failed currencies: the Roman denarius, the German papier mark, the Zimbabwean dollar, the Venezuelan bolivar. Every single one collapsed because the issuing authority printed too much, borrowed too much, and destroyed the currency's purchasing power. The U.S. dollar has been the exception for a long time, protected by America's economic dominance and military power. But that protection is weakening. The economic dominance is being challenged by rising powers. The military advantage is less relevant in an era of economic warfare and cyber capabilities. And the trust that underpinned the dollar's status is evaporating as other nations watch the U.S. weaponize the financial system for political purposes. Now, here's where this gets personal. If you have significant wealth in retirement accounts, let's say $100,000 or more, you need to understand how vulnerable that wealth is to currency debasement. Your 401k might show a certain number on your statement, but what matters is what that number can buy. If the dollar loses 30% of its purchasing power, your retirement account effectively lost 30% of its value, even if the nominal number stayed the same. This is why more people are looking at gold IRAs. I actually put together a comprehensive guide on how these work. It's in the description below. It covers the mechanics of getting physical gold into your retirement account without triggering tax penalties, which custodians are reputable, and what the fee structures look like. If you're sitting on substantial retirement savings, it's worth understanding this option, because the window to make these moves before the crowd figures it out is narrowing. All right, back to the bigger picture. Let's talk about the mechanics of the gold market itself, because understanding this will help you see why the current price action is just the beginning. The gold market operates on two levels: paper gold and physical gold. Paper gold includes futures contracts, ETFs, and various derivatives. Physical gold is the actual metal, bars, coins, jewelry. And there's a massive disconnect between these two markets. The COMEX, the primary exchange for gold futures in the U.S., trades enormous volumes of gold contracts every day. But here's the thing, most of those contracts never result in physical delivery. They're cash settled. Traders are speculating on price movements, not actually taking possession of metal. Estimates suggest that for every ounce of physical gold that actually exists, there are dozens, maybe hundreds, of paper claims on that same ounce. This works fine as long as everyone plays along, as long as most contract holders accept cash settlement instead of demanding delivery. But what happens when that changes? What happens when a significant number of holders say, "No, I want the actual metal"? You get a squeeze. And in a squeeze scenario, the paper price and the physical price can diverge dramatically. We've seen hints of this already. During periods of high demand, premiums on physical gold coins and bars have spiked well above the spot price. Dealers have struggled to source inventory. Delivery times have extended from days to weeks or months. These are warning signs that the physical market is tighter than the paper market suggests. And here's what makes the current situation so precarious. Central banks are buying physical gold, not paper contracts. When China adds to its reserves, they're taking delivery of actual bars. When Russia accumulates gold, it's going into vaults. This physical demand is removing metal from the available supply, while the paper market continues to operate as if nothing has changed. That's a recipe for a serious dislocation. The London Bullion Market Association, the LBMA, is the other major hub for gold trading. They maintain a system of allocated and unallocated accounts. Allocated means you own specific bars with serial numbers. Unallocated means you have a claim on gold, but not to specific bars. It's more like a bank account. You have a balance, but the institution can use that gold for other purposes. Most gold held in the LBMA system is unallocated, which means if there's ever a run on physical gold, a lot of people are going to discover their claims aren't as solid as they thought. This is why sophisticated investors are increasingly insisting on allocated storage or taking direct possession. They understand the counterparty risk. They know that in a crisis, paper promises might not be honored. And they're not willing to bet their wealth on the assumption that the system will function smoothly when it's under stress. Let's talk about supply and demand fundamentals, because this is where the story gets even more compelling. Gold mining production has essentially plateaued. The easy deposits have been found and exploited. New discoveries are increasingly in difficult locations, deeper underground, in politically unstable regions, or in environmentally sensitive areas. The cost of production has risen significantly. Many mines are barely profitable at current prices, and some are operating at a loss, hoping prices will rise enough to justify continued operation. Meanwhile, demand is surging. We've already discussed central bank buying, which has been at record levels, but there's also strong demand from individual investors, particularly in Asia. China and India have cultural affinities for gold that go back thousands of years. As their middle classes grow wealthier, they're buying gold jewelry, bars, and coins. This isn't speculative demand that will evaporate when sentiment shifts. This is deep structural demand rooted in cultural values and long-term wealth preservation strategies. Industrial demand for gold is also growing. Gold's unique properties, conductivity, corrosion resistance, malleability, make it essential for electronics, medical devices, and emerging technologies. As the world becomes more technologically advanced, industrial gold consumption increases. This demand is price inelastic, meaning manufacturers will pay what they need to pay to secure the gold they require for production. So you have constrained supply, record central bank buying, strong retail demand from the world's two most populous nations, and growing industrial consumption. That's a fundamental setup that points to higher prices regardless of what's happening in the broader economy. And when you layer on the monetary and geopolitical factors we've discussed, the case for gold becomes overwhelming. Now let's address the elephant in the room. Volatility. Yes, gold can be volatile. We've seen sharp corrections in the past. In 2011, gold hit $1,900, then spent years consolidating. Some people bought at the top and watched their investment decline. They got shaken out. They sold at a loss. And they missed the subsequent rally that took gold to new highs. Here's what you need to understand about gold volatility. It's not like stock volatility, where a company's fundamentals can deteriorate and the stock can go to zero. Gold doesn't have earnings reports. It doesn't have a CEO who can make bad decisions. It doesn't have competitors that can disrupt its business model. Gold is gold. It's been valuable for 5,000 years, and it will be valuable 5,000 years from now. The volatility is in the price, not in the underlying asset. When gold corrects, it's usually because short-term traders are taking profits, or because there's a temporary strengthening of confidence in fiat currencies, or because of technical factors in the futures market. But the long-term trajectory is determined by the factors we've discussed: monetary policy, debt levels, currency debasement, geopolitical tensions, and supply-demand fundamentals. And all of those factors are pointing in the same direction. Think about it this way. If you bought gold in 2000, you paid around $250 per ounce. If you held through the volatility, through the rally to 1900, the correction back to 1000, and the subsequent climb to where we are now, you've seen your investment increase 16-fold. That's a compound annual return that beats most stock portfolios over the same period. And you did it with an asset that has no counterparty risk, no management risk, and no bankruptcy risk. But here's the critical point. Past performance, while impressive, isn't the reason to own gold now. You own gold now because of what's coming. Because the structural problems in the global financial system haven't been solved. They've been papered over with more debt, more money printing, and more can kicking. And eventually, you run out of road to kick the can down. We're seeing signs that we're approaching that end of the road. The bond market is showing stress. Yield curves have inverted and uninverted in ways that historically precede recessions. Credit spreads are widening. Corporate debt levels are at all-time highs, and much of that debt was issued at low rates that are now being refinanced at much higher rates. Companies that looked financially stable a few years ago are suddenly struggling to service their debt. The commercial real estate market is in serious trouble. Office buildings in major cities are sitting empty as remote work becomes permanent. Property values are declining. Loans are going underwater. Banks that are heavily exposed to commercial real estate are facing potential losses that could trigger a cascade of failures. We've already seen regional bank failures earlier this year. That was a warning shot. The main event could still be ahead. Consumer debt is at record levels. Credit card balances are soaring. Auto loan delinquencies are rising. Student loan payments have resumed after a multi-year pause, putting additional strain on household budgets. The savings rate has plummeted. People are living paycheck to paycheck, with no buffer for unexpected expenses. This is not a healthy economy. This is an economy running on fumes, held together by momentum and hope. And what happens when the economy finally tips into recession? The government will respond with more stimulus. The Federal Reserve will cut rates and restart quantitative easing. They'll print trillions more dollars and inject them into the system, because that's the only playbook they have. They can't allow a deflationary collapse. The debt burden would become impossible to service. So they'll choose inflation. They'll debase the currency to reduce the real value of the debt. This is why gold is essential. It's the asset that benefits from exactly this scenario. When governments print money, gold goes up. When currencies lose purchasing power, gold maintains its value. When confidence in the financial system erodes, gold becomes the safe haven. It's not a coincidence that gold has been money for millennia. It's because gold has properties that make it ideal for preserving wealth across time and through crises. Let me give you another historical example. In 2008, during the financial crisis, gold was around $800 per ounce. The government and Fed responded with massive bailouts and quantitative easing. By 2011, gold had more than doubled to over $1,900. The people who owned gold before the crisis not only preserved their wealth, they profited from the government's response to the crisis. We're setting up for a similar dynamic, except this time the starting point is much worse. Debt levels are higher. The Fed's balance sheet is already bloated. Interest rates, while elevated now, have less room to be cut before hitting zero. The tools that worked in 2008 are less effective now, which means the response will have to be even more extreme. More money printing, more debt monetization, more currency debasement. And here's something most people don't realize. The gold price is still suppressed relative to the money supply. If you adjust gold for the expansion of the monetary base since 1971, gold should be trading well above its current price. Some estimates put the inflation-adjusted equivalent at over $10,000 per ounce. The fact that gold is only at $4,000 suggests there's still significant upside as the market reprices gold to reflect monetary reality. The gold-to-silver ratio is another interesting indicator. Historically, this ratio has averaged around 15 to 1, meaning it took 15 ounces of silver to buy 1 ounce of gold. Right now, that ratio is much higher, suggesting silver is undervalued relative to gold. When gold rallies strongly, silver tends to outperform on a percentage basis. So if you believe gold is going higher, silver might offer even more explosive upside. But that's a topic for another discussion. What I want you to take away from this is the urgency of the situation. We're not talking about a gradual shift that will unfold over decades. We're talking about a potential phase transition in the global monetary system that could happen rapidly. When confidence breaks, it breaks fast. When currencies collapse, they collapse quickly. And when the crowd finally realizes what's happening and rushes for the exits, there won't be enough gold available at reasonable prices to satisfy demand. This is why central banks are buying now. They're not waiting for confirmation. They're not waiting for mainstream consensus. They're positioning ahead of the crisis because they understand that by the time it's obvious to everyone, it will be too late to act. The gold will be locked up in strong hands who won't sell at any price. Premiums will explode. Availability will disappear. Think about what happened with toilet paper during the early days of the pandemic. Suddenly, everyone wanted it at the same time. Shelves emptied, prices spiked. People who had stocked up beforehand were fine. People who waited found themselves scrambling. Now imagine that dynamic with gold, except instead of a temporary supply disruption, it's a permanent shift in the monetary system. The people who own gold before that shift will be positioned to preserve and grow their wealth. The people who don't will watch their purchasing power evaporate. I'm not trying to scare you. I'm trying to wake you up to what's happening. The signs are everywhere if you know where to look. Record central bank buying, unprecedented debt levels, persistent inflation, geopolitical fragmentation, de-dollarization. These aren't random events. They're all connected. They're all pointing to the same conclusion. The current system is unsustainable, and gold is the asset that will preserve wealth through the transition to whatever comes next. You have a choice to make. You can dismiss this as doom and gloom. You can assume the system will muddle through like it always has. You can trust that governments and central banks will figure it out. Or you can look at the evidence objectively and ask yourself, what if they're wrong? What if this time is different? What if the can kicking finally stops? If you're wrong and gold doesn't rally further, you still own an asset that has held value for thousands of years. You haven't lost anything fundamental. But if you're right, if the system does reset, if currencies do debase, if confidence does break, then the gold you own today could be the difference between financial security and financial devastation. The cliff we're standing on isn't visible to most people yet. They're looking at stock prices and housing values and feeling wealthy. They don't see the erosion happening beneath the surface. They don't understand that nominal gains mean nothing if the currency those gains are denominated in is losing purchasing power. They're focused on the wrong metrics. But you have the opportunity to see clearly. You have the information. You understand the dynamics. The question is, what are you going to do with that knowledge? Are you going to act while there's still time? While gold is still available at prices that will seem cheap in hindsight? Or are you going to wait until the crisis is undeniable, when everyone else is trying to buy at the same time? History will look back at this period and identify it as a critical inflection point. The people who recognized what was happening and positioned accordingly will be remembered as prescient. The people who ignored the warnings will be remembered as cautionary tales. Which side of that divide do you want to be on? The edge of the cliff is closer than most people think. The ground beneath our feet is less stable than it appears. And gold, physical, tangible, no counterparty risk gold, is the safety net that can catch you when the fall begins. Don't wait until you're already falling to reach for it. By then, it will be too late.